My name's Damon Purcell, and welcome to our roundtable today on the resources sector. Today I'm joined by three fund managers, Matthew Langsford from Terra Capital, Dan Porter from Pure Asset Management, and David Franklyn from Argonaut Resources. Gentlemen, welcome.
Thanks, David.
Thank you.
Gents, what we might do is just start off with a very brief introduction, who you are and how you invest money in the resources sector. We might start with you, Dan, if that's okay.
Yeah, absolutely, Damon. And hi to everyone out there. Look, my name's Dan Porter. I'm portfolio manager for the Pure Asset Management Resources Fund. As a fund, we set up shop about 4.5 years ago, and I joined in 2.5 years ago to set up the resources fund. We aren't a conventional equities fund. We're a hybrid debt fund, and we're focused on the small end of the market. So effectively what we do is take an old style of convertible note and break it down into its two core components. So we've got a straight debt piece on one side, and overlaying that is warrants and options. So when we're looking at smaller companies, we invest sort of that $5 to $15 million range on the debt side, and then look for equity exposure via those options. And I think that is performing very well in this market. We're definitely outperforming the broader index, and certainly that volatility we're trying to smooth out through our debt pieces as well. So certainly seeing a lot of opportunities to deploy capital in this type of market. Everyone's unhappy with their share price, and definitely our facility is something that we find is less dilutive and definitely need in that small cap end of the market.
Yeah, it's an interesting process, and I think it fits really well in the discussion that we're going to have today. David Franklyn from Argonaut, let's hear a little bit about you and how you fit into the broader market.
Yeah, look, the Argonaut Natural Resources Fund can invest across the entire resource spectrum, from the biggest companies to the smallest companies. We have a pretty rigid process that we go through. So the way I describe it is, firstly, we look for the key resilient themes that are going to impact on the resource market over the next 5 to 10 years. From there, we choose the commodities that we think are best placed to benefit from those themes. And then from there, we look for the best quality, best value companies that produce those commodities or are looking to produce those commodities. So as you'd expect, one of the key themes at the moment is energy transition, and so a lot of our focus is around the commodities like copper and nickel and lithium, rare earths and uranium, which we think will be beneficiaries from that. We're high conviction, so typically between 10 and 25 companies in the portfolio. We can go to 30% cash, which gives us some protection in a weaker market, and have a real focus on mitigating risk by ideally making sure the projects are located in Australia or Tier 1 locations. So that's it in a snapshot.
And finally, Matt Langsford from Terra, you look across the spectrum and have a couple of interesting fund options as well.
Yeah, that's right. And thanks for having me on. Yeah, so we run two global long-only, equities-only natural resources strategies. The flagship has been running, it's going to be 13 years in a few days at 30 June for the flagship fund. And then more recently, we started the Green Metals Fund, which is very similar to what we have been doing for 13 years, just no fossil fuels in the portfolio, which is appealing for some investors because they just want exposure to those future-facing commodities. But similar to David, we do run that top-down, bottom-up style process where we try and pick what commodities will perform best over the medium term, and then we spend all our time bottom up. What are the best copper stocks we can buy globally, and then assemble a portfolio after that. And it's been an interesting time, as I think everyone here would attest to.
Yeah.
A good way to sort of start it off. If we talk about the growth of and also the decline of certain resource sectors, how are you guys capitalising on the change in, I suppose, the world's view on some of these resource sectors and the ones that are potentially declining or looking to decline at some stage in the future. How do you guys capitalise that? Dan, given the way you invest, let's start with you on this.
In the fund, we don't have a particular commodity focus. We say that we're commodity agnostic. But certainly a key focus for us in the last 18 months has been on that critical minerals space. And one of the reasons for that is the traditional financiers have not been there to finance a lot of these projects in their earlier stage of development. And often that's because the end markets are very opaque. You know, a lot of products come out of China. The world is looking to, devolve itself a little bit in terms of supply chains. And certainly there's a lot of interest in that critical minerals space, but the traditional financing just hasn't followed as yet. It will over time, I'm sure. You overlay that with a sort of dearth of funding in the small cap resources space more generally. A lot of the small cap managers have had mandates pulled over the last 12 months, and that has really impacted a lot of the commodities as well, and the smaller companies. So we in our fund, we're not a traditional lender by any stretch. We don't need to hedge. It's not a requirement for us, which is helpful for a lot of the critical minerals companies because the markets aren't deep enough or liquid enough to be able to do that. But we are certainly looking at those smaller companies that are coming into that production stage and hence can warrant a piece of debt going into that business. But similarly, we've found that there is a plethora of opportunity out there just because the equity markets haven't been supportive. They've been very volatile over the last 12 months, and it really doesn't matter what commodity you're in. For want of a better term, gold price might as well be $1,000, and copper might as well be $2 a pound for the amount of financing interest that we've seen from other financiers out there as well. So we do have a good exposure to critical minerals. We also look for strategic type investments, and that's why we have invested a couple of positions into the East Coast gas market. For an Australian perspective, despite the fact that we are the world's second biggest exporter of LNG, we are perilously close to running out of gas on the East Coast, and happy to say that we're supporting two projects that are coming into that production phase as we speak.
David, your mandate is much broader, and that long only sort of mandate. Are you seeing opportunities in some of those declining markets, as Matt said, in things like East Coast gas and those sorts of things?
Yeah, I mean, maybe I'll step back a bit first. You know, I think it's instructive if you look at the Australian resource market, and one of the index that we use, our benchmark, is the ASX Resources 300, right? And if you take the iron ore companies, the coal companies, and the oil and gas companies, they represent probably 70% or more of that index. And what that reflects is history. That's where Australia's made its money, from resources. And I think the really fascinating thing is the world is changing, and we see the opportunities are not in those groups, but they're in copper and nickel and rare earths and graphite and uranium. And I think that's a really exciting time. So I think what you're seeing on the coal side, in particular, there's opportunities, but you're buying cash flow at a discount. But what the market's really focused on is what's happening in the future, and that's really where our focus is.
Sorry, go on.
I missed your point on East Coast gas. We have looked at that. We've looked at Cooper Energy in particular. We think there's clearly, resource investing is all about economics and supply and demand. And what you got there is demand is strong and supply is dropping off, so there's opportunities. So, we also look at those, and I think that's an emerging opportunity there.
And Matthew, for you guys having a broader global mandate, is there opportunity in some of those sort of larger scale resource opportunities in more developing markets, or is this are you seeing a similar sort of thing to what both Dan and David are seeing?
Yeah, I think it's the paradox of the energy transition, whereby supply is being cut off for some commodities when there should be a transition, and so that's creating strange dynamics. Right now we're seeing a lot of equity market interest, and I think that'll continue in the future-facing commodities. But also, I think it's going to create price gyrations in those, those old world commodities, for the lack of a better term, at certain times. And while we're not super bullish on iron ore or coal at the minute, our flagship fund definitely will invest in those commodities at certain times. I think, but for that fund, which isn't constrained by only investing in the future facing commodities, I think as commodities investors, we're there to take advantage of those price spikes in the event they occur.
If we move on then into something that's probably closely related to those price spikes and look at technology. David, I'll go to you. What sort of emerging technologies are we starting to see that you think might, have a significant impact on resource markets?
Yeah, I think it's a really good question, because I think that the risk for energy transition is, can supply keep up with demand? And I think one of the solutions to that is doing what we do, but doing it differently, so we can bring supply on at a faster rate. A good example in the lithium space is direct lithium extraction. Technology is not really there yet. A few people are proposing it, and it'll be interesting to see how that goes. But, you jump 5 or 10 years down the track, it's going to be there, it's going to be reducing, and it's going to have a big impact on the market. Similarly, if you look 2 years ago, one of the big threats and risks in energy transition was, where are we going to get our nickel from, and where are we going to get our cobalt from? And what you're seeing with some technology advancements out of Indonesia is suddenly, those shortfalls are rapidly disappearing, particularly in the cobalt space. So I think it's an evolving thing. It's going to be part of the industry going forward, but ultimately it needs to happen if we're going to meet the increase in demand profile.
And from your point of view, I assume that given that you're got exposure on the debt side as well, are you looking at any interesting technologies, or is there anything that's really sort of standing out to you?
From our perspective, or from a pure perspective, we're happy to invest in mining services companies as well, and we've made investments in the past. To follow on from David's point, I think what I'm sort of noticing more and more, and certainly we're seeing a few more companies coming to the market and developing technology in the space, is on sorting and grading technologies, and I think that's going to be really important as we move ahead. Grades of all commodities aren't what they used to be. We've mined all the easy stuff effectively. It's getting deeper. It's getting more expensive. We're going to have to do more with less. But with really good sorting and ore sorting, you can take an average deposit and beneficiate it up to a much better looking resource that hits a better grade. So I think technology and investments in that area are taking off, and they're taking off across the spectrum, whether it's smaller, critical minerals like tungsten, or moving into even the bulk commodities in iron ore and coal as well. We're seeing a lot of investment going into that. Now, a lot of it will be done by the companies in-house, the BHPs, the Rios of the world. But certainly we see a lot of scope for smaller companies to take advantage of this and to really drive profit. Small investment in sorting can go for a long way in terms of lifting your grade and the price that you achieve in the market.
Matthew, what about from Terra's point of view?
Yeah, we've seen a bunch of proposed technologies, whether it be on the lithium side and the clay processing and direct lithium extraction, improving copper recoveries from jetty resources and the like, or then other high grading of iron ore processing to end up with lower carbon intensity steel. All these technologies trying to extract more for less, whether that's less money or less emissions. It's an exciting space. We, as investors, though, we honestly try to avoid the word new in our investee companies when they're trying a new processing technology or process or going downstream where their expertise aren't. it's just a bit of a philosophical view, and one we've probably learned the hard way over the years. But I'm there for it once they're up and running.
Yeah.
Well,
I think just following on from that, miners don't want to necessarily be the guinea pig. They want to use what works. So if you've got a brand new gold processing technology, there's not a lot of people out there who are going to take that up. But if you've got incremental gains, I think that's where you can make it. But completely agree with Matt's point there. There's not a lot of miners looking at the groundbreaking end of the curve in terms of new technologies. Yeah.
Matt, I'll ask you on this one because it's probably right in your wheelhouse. Geopolitical risk, for mining companies. Is this something that you feel you've got to start to assess more in when you're buying different companies, or is it something that you're assessing less? What do you look at when it comes to geopolitical risk for the sorts of companies you're investing in?
I think, despite the fact that in the developed world, the deposits all the good deposits are probably gone. Most of them are gone anyway. Despite that fact, we still have a massive preference for politically stable, for lack of a better word, first world jurisdictions. Mining is hard. Geology is inherently variable, as is mineral processing. There's enough risk in the process there already without going to a jurisdiction where there's a likelihood or there's the potential for your asset to be taken off you by the government, or for a regime to change and taxes to jump up. So for that fact, and for the fact that I think we're going through a process now, certainly is the desire of the EU and the US to reindustrialize and move some of this critical minerals production back onshore. I think that favours those jurisdictions again. And so while we do look completely globally at asset locations, something has to be pretty special for us to stray too far from the I guess tier one jurisdictions.
And David, how do you and Argonaut sit on the geopolitical risk? No doubt you've got exposure there as well.
You try not to go there. I mean, it needs to be compelling from a value and quality perspective to go there. But and we track it pretty closely in our portfolio, how much international exposure we have, and then where that is. And I think really there's two factors there. One, when you go to those higher risk locations, there's a lot more risk around permitting and licensing. There's environmental concerns, which you can't always get the same kind of transparency on that you can in Australia. But I think the second aspect, which is perhaps overlooked a bit, is the Australian. If you're an investor in Australian listed resource companies, the market's very unlikely to apply the same rating to a project in a high risk location as in Australia. So you're also discounted. A good example is the gold sector, where the way we describe it is there's some good quality gold companies listed on the Australian Stock Exchange, have projects in West Africa, but really they need to produce twice as much gold to get the same market rating as an Australian producer. And you just go, well, I might as well just buy an Australian producer and mitigate risk. So that's really the approach we take.
Dan, what's your thought on this? Is this something, obviously being on the debt side, you're delving quite deeply into some of these projects.
Yeah.
How do you guys approach geopolitical situation?
Yeah, look, very similar thoughts as to Matt and David as well. We only invest under our mandate in tier one locations, so effectively Australia, North America, and Europe. We don't look at many developing nations. Again, it's too high risk. We're taking security over these projects, so legal jurisdiction is a very big concern for us. When you've got a set of laws that's under a Westminster system, it's much easier to get debt documents signed up and to exercise security if we ever need to as well. So we're very much down the risk curve from that perspective. But I think a lot of investors are, and certainly our own investors in our fund tend to be a bit more cautious. But I think globally it's a concern, because where are we going to get the next big copper hits from, and how are we going to pay for them? You need a lot of money to build big mines, and it's we're at a very interesting point in the commodity cycle, in that we know in the next 5 years we're going to need a lot more commodities, and expects exceptionally high amounts of commodities. We're going to likely recessions now globally, so commodity prices are reflecting that as well, which sort of deters investment again. So we're in a position where unless we get some serious policy changes or something like that, it's going to be a very tricky time in the next 2-3 years in commodity markets, I think. But also will probably mean that we'll have commodity prices underpinned being higher for longer. The highs will get higher, the lows will get higher as well. But in saying that too, cost bases are probably moving up. So look, it's not a terrible time to be a miner. It's just a tricky time.
David, if I could ask you, first of all, I'll put my hand up and say I'm a bit of a greenie. So I approach this with my hand on my heart. If we look at some of the challenges faced by the traditional mining companies as we look to the transition to more sustainable or sustainable energy and materials, what are the sorts of things that you're looking for in companies as the world slowly but surely starts to move to a more renewable, more sustainable sort of ideal?
I think the key point is more mining in particular commodities is necessary if energy transition and the whole ESG process is going to move forward. So the fact is we need mining in particular commodities. And so what we've got to make sure is that the companies are doing it in the most efficient way, environmentally friendly way, and obviously with governance and compliance measures first class. I guess in Australia, we have a very efficient system. And I think most of the companies, the bigger producers, will see that the way they can maximise their rating is to be at the forefront as far as environmental, social and governance issues. And so I think we're seeing that. I think it's probably the second and third tier locations where you worry more about those. But I think the mining industry recognises there's a real opportunity to move into the mainstream, given what's happening and what's required. And I think that, in most of the tier one locations, as far as investing, they're doing that pretty effectively.
The Australian media talks quite a lot about sustainability, both on both sides of the media. In a global sense, is this something that other resource companies around the world are facing on an ongoing basis, and what do you think is quite unique about some of the things they're looking at?
Good question, and something that we experience often is the divergence in consideration of ESG factors between different geographical groups of people. You've probably got the Europeans who are far ahead of the rest of the Western world. The US is a bit behind there. Australia is probably lagging even further on ESG considerations, honestly. And I think in the last 2 years, we've seen mining companies realise that ESG has to be part of their strategy. Then there's a huge array of different approaches to that, from the very pragmatic and realistic to just one slide in the presentation. And now it's actually a big part of our process to assess mining companies for on their ESG credentials and hold them to account. Because if you're considering social license to operate and permitting risk on any time frame, you need to have ESG being first and foremost in the company's philosophy of how they operate. It really does increase risk if they're not taking it seriously. And then further to that, we've even gone to the extent of coming up with our own ESG scoring system for companies so that we can assess every company we see, because and not just because it's the right thing to do, because there's economic imperative for companies to do that. They'll get the lower cost of capital. There's more equity participants who will look at a company that's doing the right thing on the environmental side. So, and therefore better valuation. So it is critically important now, and it's nice, 10 years ago in the fund, in a mining fund, I didn't really feel like I was necessarily doing the right thing on the environmental side, but now I can say from being a laggard, the mining industry is really coming up the curve. So it's good to see.
Dan, I'll pose the question a little bit differently then, given what Matt's just said. Is the viability of some of these companies, particularly the ones that are going to be slower to move, is there an opportunity to see a changing of the guard somewhat in this sector as a result of that? If there's a few Titanics trying to turn around a few ships trying to turn around in the Suez Canal versus a few speedboats, are we a chance of seeing some companies go down or certainly feel the wrath of not having sustainable policies in place?
Yeah, that's a very good question, Damon. I think you're right. I think Matt touched on it. It was a pretty good answer to the question, I have to say. In that, I see certainly at the junior end, the companies have moved up the curve in a whole range of different indicators. Effectively, it's not the same market as it was 10 years ago. It's much harder to get financing for a project for a start. And it's also much harder to get permitting and projects approved. So companies have to be better if they want to get a gold mill or a tungsten mill or something approved. You've got to tick a lot of boxes, and companies are really moving ahead in that regard. They're professionalizing. The sort of, I guess, the cowboys have moved out of the market. They don't really exist anymore. You still get a few colourful types, but certainly projects are a lot better quality than they were even 5 years ago. And I think a lot of miners have really focused to the credit on the social and governance side of things. They're pushing that, even if they're involved in assets that might be old world commodities, gas, coal, that type of thing, iron ore. Certainly. And I think there's been some spectacular failures in that regard as well, historically, that has resulted in boards being completely turfed. Rio Tinto, for example. Now, that was a very hard lesson to learn, but a very public lesson, and probably good for the sector in that everyone's seeing that. That is one of the most public companies in Australia, and there was a lot of focus on it, and people are genuinely worried about that now, and that type of thing. So that engagement with communities, I think, has really picked up. The engagement with government has had to pick up because there's a lot more regulation. It's, what used to take 18 months to get a permit is now 10 years. And so you're spending a lot more time with the government. The government is making sure that you're doing the right thing to the extent that they can. And then the environmental focus has been really big, and I think we're seeing that just in a small anecdotal way in terms of tailings projects. We've seen tailings projects that have come to the market. They're actually, as part of rehab strategies now. Companies are making money from them, which is good. It's a good thing, but they are actually cleaning up after themselves, which I think is good for all of us. Yeah.
Just quickly, sorry to jump in, but I think it's actually happening already, whereby you see the rumored takeover from of First Quantum by Barrick. A gold company trying to get copper into the mix. Newmont, Newcrest, same thing happening there.
Yeah,
I think certainly for those companies and BHP trying to increase their copper exposure. I mean, it is happening.
Glencore and Teck, for
Glencore,
example,
right?
Yeah,
Glencore, Teck, which is same type of thing. I think and for the developers, I think it is very hard for existing operations to reduce carbon emissions. Very hard to retrofit a mine to be carbon neutral, even reduce emissions. It's difficult depending on where the assets are located and what exactly they are. But I think we will definitely see more polluting incumbents take over less polluting developers as they try to increase production and lower the overall company emissions profile.
Dan touched on government influence. David, in Australia, in the resource sector, we've heard profit super taxes or super profit taxes talked about, and those sorts of things. Regulatory frameworks and government intervention, how much effect is that having on resource companies, and how do you look at that, and what are the sorts of things that you're looking at with the sorts of companies you invest in on how they deal with that government intervention?
It's a massive factor, and it's something you need to keep a close eye on. And I think in recent history, our focus might have been on countries like South America, with Chile and Peru, big copper producers, and the the changing decisions they might make around royalties, tax rates, and all that. But and you'd hope that it was limited to those kind of jurisdictions. But even in Australia, we're now seeing some actions that really create uncertainty. And what the market doesn't want to see and what investors don't like to see is uncertainty, and that's what we're getting. So you saw it recently in Queensland with the change in the tax regime on coal, and even in Western Australia, there's some heritage legislation going forward now, which really just makes it a lot more difficult, a lot more onerous, but there's a lack of clarity and I think really thought and process around the decisions being made. So I think, unfortunately, it's going to be a feature of the resource sector going forward because as part of that whole ESG move. So I think the intention is good, but often the execution is poor. So it's something that's going to slow down the development of projects, which is one of the factors why supply will struggle to keep up with demand in all likelihood.
And Dan, what about you from this point of view? I mean, obviously you're playing both sides once again. There's a lot of regulation in lending, and there's a lot of regulation in the approach to minerals and resources companies. How are you seeing it?
It's a very big consideration for us. We're looking at companies that are going into that production stage. So we are looking for any sort of risk elements that can delay that. We want to see companies that are going into that stage in sort of 12 to 24 months. So if there is something that can delay that, and often it's permitting and approvals, then we are very cautious around that. It means we do invest in a lot of brownfields projects where they've got mining leases. If you've got a mining lease, you're 10 years ahead of someone who's next door to you, same commodity, same region. But you are literally a decade in front. So given our debt facilities last for about 4 years, we don't want to take 10-year permitting risk. So it's definitely something we think about. But when we're investing too, we're aware that mining is risky and sometimes things go wrong. So if we do need to exercise security in a situation, we're looking at companies that we know we can get an exit from. If you're investing into older technology or older style commodities, there may not be that many buyers for those types of assets in 4 or 5 years' time. So we're very focused on getting an exit potentially. We know that we're going to be able to sell a nickel mine or a copper mine or a cobalt mine if we need to.
And Matt, for you, is this something, I mean, this is clearly something as some of these developing nations, start to realise the value of these assets. That's got to be something that affects investments in global resources.
Yeah, absolutely, and I think it just drills home to me as an investor that you want to be in stable jurisdictions, even though we have had those tax changes David mentioned in coal in Queensland and heritage in WA. There is a little bit of leeway if you're dealing with future-facing commodities. I think the oldest, your coal, your fossil fuels essentially are really sitting ducks in the event you get those price spikes, which is somewhat unfortunate given it is a transition. But that's the nature of the political environment that we're in.
It's certainly been a reasonably solid last couple of years for the resource sector in comparison to sort of the broader industrial sector. Just looking at the numbers I got pulled this morning, the over 1, 3, 5 and 7 years, the S&P ASX All Ordinaries had underperformed the All Resources at the 200 level, reasonable amount. One of the people who, one of our attendees has just asked the question though, any thoughts on the strong performance of quite a few critical mineral explorers, particularly in the last 4 to 6 weeks? David, I might put this one to you. Is there a couple that have all of a sudden just jumped out and done quite well?
Yeah, look, I think it's just a reflection of interest in the whole energy transition space, and investors are always looking for the next shiny thing, right? The next good thing. Often the rallies are on the back of some exciting drill results, and that creates a bit of hype and a bit of attention. I think you always got to be careful, because often they can get a bit inflated, and there's a disconnect between where they're at and what their value is. But I think it's really just a reflection that people are interested in that space. You've got to be cautious. You always got to come back to quality and value, and timeframes, as I think is probably a key theme from today. It's not easy, and it's a long time from having a good drill result to producing an end commodity. So you've got to bear that in mind.
Dan, anything to add on that?
Yeah, no, we've definitely noticed, had a eye on a few things, and we've seen some amazing price spikes, things doubling on the back of good drill holes and that type of thing. I think it's a little bit of the nature of the market at the moment as well, and a lot of it's driven by retail at the minute. Retail buying, you've seen a lot of the lithium names bounce back really strongly. And certainly seeing some good drill results out of WA, similarly copper and nickel. But yeah, to Dave's point, it's a long time between drilling a good hole and bringing that into production, and we're looking at that next stage. So definitely keeping an eye on some of these smaller companies. Often we're investing at the time where those companies are putting out a lot of engineering reports and that type of thing. It's not that interesting as putting out a copper grade at 8% copper, or a drill hole at 8% copper. So that's when we tend to get involved in these companies, when there is a need for capital, but their share price doesn't necessarily reflect where they're going. So that's where our facility helps and aids these companies to get to that production stage. But I think we'll continue to see some sporadic names bouncing. But again, I think it's driven by a lot of retail hype at the minute.
Yeah, I think it's an interesting time because there's a dearth of IPOs as well. So people are looking for something interesting and pretty much jumping on anything they can. Another question.
Just on that, David, if I can jump in, I think there's only been 10 IPOs this year, which would be an all-time low on the ASX.
Yeah, absolutely. Yeah, it's quite amazing. Matt, a question for you from the audience. Inflating costs, is that a major concern, ongoing concern, or do you believe we've seen the worst of this? And let's look at that locally initially.
Yeah. Well, WA's got about the worst cost inflation of any jurisdiction that we look at as a result of a shortage of staff. And although some input costs have come off, it's hard to see that dissipating drastically in the very short term. We do consider it. We model every company, and high costs are hard to avoid. And then you're sometimes reliant on just the commodity price. And we want to we do want to expose ourselves to the operating leverage of good management teams. We don't want to necessarily do that in really high cost environments. And so it is impacting where we're putting new capital to work, and it's impacted some of the changes we've made to the portfolio over the past 18 months.
I'll follow that one on. It was mentioned earlier, and this is another question from the panel, of some of the attendees, that regarding East Coast gas, ScoMo's mantra was a gas-led recovery. Do we need more exploration on the East Coast, and is a lack of gas or an energy crisis in Australia inevitable? I'll go to you, Matt. You're on screen with me at the moment.
Oh, sorry. Probably hand up. I don't have any East Coast gas investments at the moment, so I'm not your best man on that one.
David, what do you think?
Yeah, well, I think Matt actually touched on it earlier. You know, the issue is in an energy transition, you got to deal with demand before you deal with supply, right? And what's happened around the world is everyone's going, well, we don't want to be in coal, we don't want to be in oil and gas, and therefore we're going to start to stop the investment there, but demand hadn't fallen off in time, and you get that price pressure. So I think gas is going to be necessary as part of the transition. And therefore you need to make sure you've got enough. I mean, the emissions from gas is substantially less than from coal, and so if you're looking at some baseload power until you get renewable sources and battery storage or whatever, you're going to need it. And what the public don't want is they don't want prices spiking and the impact that has on inflation and whatever else. So I think it's a transition. We're going to have gas is going to be part of the mix for the medium term, ideally not for the long term, but I think it's there to stay. Yeah.
Gentlemen, thank you. We've just hit our timing. Matthew Langsford, Dan Porter, and David Franklyn, thanks for your time this afternoon. Very much appreciated, and I'm sure our attendees appreciated it as well.
Thank you for having us.
Thank you. Great to be part of it.
Just a couple of little housekeeping points. A copy of this webinar will be sent around to all of the attendees, and it will be available on the fundmonitors.com website. For those of you who are interested in Terra Capital or Pure Asset Management or Argonaut Funds Management, information on each of these funds is also available on fundmonitors.com. Once again, thank you for everybody's time this afternoon. We hope you've enjoyed the webinar, and we look forward to seeing you again next time we have a webinar. Thanks very much, gentlemen.
Great. Thank you. Cheers.
Thank you.